Welcome to Poor Millionaires. Today's guest is Manish Singh. Manish is Chief Investment Officer at Crossbridge Capital, having previously worked in wealth management and investment banking at UBS and Societe Generale. Here we discuss why it pays to ignore the doom-mongers and focus on long-term positioning for success. Poor Millionaires is the show for people with investable wealth of $1 to $20 million. We strive to educate, connect and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value of investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Manish Singh, welcome to the show.
Thanks, James. Nice to be here.
Good stuff. Manish, you've had an impressive career spanning roles at Societe Generale and UBS, and you're now Chief Investment Officer at Crossbridge Capital. But before we dig into the nitty-gritty of today's discussion, I just want to explore with you a little bit about your background, because you originally studied chemical engineering at university, right?
Yes, correct.
And that immediately got me thinking that this is somebody who comes into investing with a different perspective to most people in the business. How do you think having this type of academic background has influenced your investing approach?
So I would say, James, that, what happens if you've done maths or science is that you become very systematic in your thinking. In the sense, you look for data and evidence. You can cut through the noise. You can look at things and, it's just a waffle or it just doesn't add up. So you're always looking at evidence. And in maths and science, there's always one answer, not 100 different answers. So I think that helps also to identify where things are going on. And lastly, I would say that when you have done science or maths, you don't look for definitive outcome. You look for probabilistic outcome because you know that there's going to be a scenario. And then you attach let's say if you're looking at 5 different stocks, you look at what is the likelihood or what is the percentage of gains that you can get from a particular stock. And then you multiply that, what is the likelihood or the probability of that happening? So when you do that, you come with an expected value. So if I'm looking at, let's say, if you're doing a structured note analysis that I do, or let's say if you're looking at 2 or 3 investments and somebody's saying this is going to make you 20%, one is saying 40%, one is saying 50%, that doesn't matter because what really matters, what is the probability of you really getting that return? So if the 20% return, the likelihood is high, let's say 60%, that's 12% expected value. But for 50%, if the likelihood is small, even if it is like 20%, that's just 10%. So, you will go for a lower investment expectation return because the likelihood of you getting that return is higher compared to what the headline number is. So you don't get swayed by big numbers. This stock is going to go 100%, 200%. You think in terms of, okay, what is the likelihood of this happening? So in my opinion, that gives you an edge when you think probabilistically and not definitively. And that also happens when you're looking at rates. People get excited, 25 basis point, 50 basis point. You kind of ignore some of these questions and you look at, okay, what is the likely outcome of rate cut happening? And how is that going to change the sentiment, which allows you to then take a view on a particular asset class? So those are things, it helps you, in my opinion.
So that's interesting. It's very kind of like scientific approach, but we always talk about, investing either being a science or an art form. So I'm guessing, do you sit somewhere in the middle of that? Or?
I would say investment definitely is an art because you can build a model, you can build expectations, and which is where very systematic people can get it wrong. And you're seeing now with central banks, using the model that they have built in 1970s. And look how many people have expected inflation to flare up time and time again. It doesn't happen because not only those models cannot keep up because it's art and not science, but also the input factors, the way people are living, the way people are consuming, the whole supply aspect, the demand aspect keeps changing. And you cannot model or parameterize most of these things. So there always has to be a judgment. But then you can't be just flying blind, not have a model or aspect to it. So I would think that, you should use a spreadsheet or number analysis or model to guide you, but the decision making cannot be left to the model. And that's where I think the art comes in. And the science is where you have to put the data in a spreadsheet and have a bit of system to analyze it. But then the art takes over. It comes from history, the understanding, taking risk. I always say that, somebody can copy my trade, but they can't copy my conviction. So we can both go along the same asset. And if we look 2 years down the line, people will have different performance. Not just me, but anyone. You can copy anyone's trade, but you can't copy the conviction. Because how do you respond to when the interest rate changes? When somebody comes and tells you a big headline, Fed is going to do that, it may not happen. And to me, that is the art part, which is never going to change. And that is the part that really delivers return to whether it's a retail investor or institutional investor. It doesn't matter. Your personal thing always catches up, and behavioral element, in my opinion, are much, much bigger and understated than the mathematical element that people talk about.
I think one of the things that shines through for me with your LinkedIn content, and by the way, I would advise everybody listening to the show to follow you on LinkedIn, because the content's really great. I find it to be very, it cuts through the noise, and it just offers a bit of a fresh perspective to the usual kind of stuff that you get there on LinkedIn. So please do go and follow Manish on LinkedIn. I just want to say the content that you put out there, it's kind of it offers a bit of more of an optimistic perspective than a lot of the things that you see on there, and I think that when it comes to being a successful investor, it's easy to forget that so many people conflate volatility with risk, and the doomsayers out there are not really helping this kind of perception. So can you just explain to us your framework for understanding risk?
Absolutely. So I do agree with you that, you will possibly see more positive from my writings and things that I have said than negative. And I would say, for simple reason, is that unless you believe that humanity is coming to an end, there's no point of being negative. Because ultimately, what is GDP? GDP is sum total of economic activity. So unless people start thinking that, okay, half the people will stop working, they won't consume, they won't eat, they don't do anything, economic activity is going to increase. Second is that when you buy stock or buy equity, you're buying nominal, not real. And you know that inflation is not at 2%. That's what the central bankers tell you, the model tells you. But if you went and bought a sandwich from M&S last year and this year, you can do the math what the inflation is. So it's not at 2%. It's always around 5 or 6%. So if you hold yourself into cash, or even to that matter bond, if you are a young investor, then you are eroding the value of your asset. So I think that there's absolutely no point like holding cash or just being in bond when you have long time horizon in front of you, and you know that your spending is going to increase, or more, or you will need more assets down the line. So I think not being an investor and not being an asset owner, and I just don't mean only equity, but even property or anything else, is not going to help you, because you will have to really earn a lot of real money to cope with the spending that is going to come up. So number one. Second, why do you have so many bearish commentators? I think it's very, very simple. When I say something positive, it will always come across as a sales pitch. When I say something negative, I'm your savior. I'm trying to help you. I'm trying to look after you. I'm going to help you keep this money.
It's almost like people are suspicious of people that are positive.
Absolutely, absolutely. So it's the same thing in society. If somebody tells you anything positive, you say, why is this guy being so positive? Why is this person? So I think that the behavioral aspect just takes over. So they will ignore the underlying reality, as I said, is that inflation is higher, nominal asset prices keeps going up, and you need to be a participant in that nominal asset prices to really have your asset base increase. So the bearish commentators will come out. They will always have this savior mentality. I'm going to save you. I'm going to save you from the risk coming down the line. Now look what happens. When the bearish commentator gets it wrong, what happens? The equity market has gone up. You're euphoric because you made money. So you don't care about what the bearish guy told you. But if the optimist guy says something and the market goes down, you remember that because you remember your losses. So this is the asymmetry. So an optimist guy has to be right all the time, but the bearish guy has to be right just once, and they become like phenomenon. Oh, this guy got the 2008 financial crisis right, and after that they got 20 different calls wrong. Nobody remembers because the market went up. So you don't have that feeling of regret or something.
Yeah.
But so this is where I would say every investor has to understand that the things are stacked against you and you will always have more bearish commentary. When the market goes up, people say 1%. When the market falls, trillions wiped out. Why don't you do that maths and say trillions added? It's not. It's 1% or 2% rally. But when the market falls, 200 billion wiped out a FTSE 100 index. That's how the framing is. So as an investor, you have to understand that the framing is always more on the negative side because that's what sells and that's how people react to it. So you have to adjust for that biases, not just what people are telling you, but how you consume that news. Because everyone has this bias within them and therefore they find it so easy to accept and easy to run with. So this is why I would say that you will see far more bearish commentator, not just now but in the future, and that's not going to change.
Yeah. It's funny, isn't it, how you always see in the news, the front pages, oh, the FTSE's collapsed or whatever, but you never see that, over X amount of years it's added, so much market cap or anything like that. But anyway, yeah, so if we sort of agree that following the advice of the bears sort of consistently makes you poorer over the long term,
yes,
how do investors insulate themselves then from that kind of commentary, but also whilst keeping kind of like a bit of a healthy dose of skepticism, because that's one of the biggest challenges as an investor, isn't it? To kind of keep a level head when things are kind of all over the place. So what's your philosophy on that?
So I would say that first I would say that do not listen to like 20, 30, 40 different commentators because then you can't keep a scorecard. And I would say that you have to have a scorecard mechanism in your head that if somebody has given you advice or somebody you have been reading or listening to, then always try to keep a scorecard of how that has worked out. So if you're reading from 20 different sources, and I would say 90% of the data analysis will be same, you're really wasting a lot of time reading the same thing. And you just remember one or two things and that catches your fancy. So I would say that use your bandwidth to do more feedback, to have more scorecard. So that the person you're reading or person advice you're following, what they said last year, the year before, and what there has to be a method, because if you just keep layering new view over old view, then you don't have a scorecard and you do not know who's giving you what advice. And then it's basically like a wind vane, whichever is topical at this time, that person becomes my person to go to, So the bearish wind is blowing, so I'll go with all the bearish guys. Bullish, I'll go with all bullish. It doesn't help you. So every investor, in my opinion, when investing, has to learn every day, just like every investment advisor learns and everyone else learns. So there is no shortcut to really being a good investor. Nobody is an overnight success. It takes 10, 20 years of overnight working to make it a success. So I think the same thing applies to, it's like, how people make their own wealth. If you're an entrepreneur, how did you make your money? Did you make your money by listening to 30 different people, or did you follow a few advice and worked on it and then made your money? I think the principle should not change. And if there are 20 good guys, you don't have to follow all the 20 good guys. You can work with 2 of them or 1 of them. That's fine. So I think it should not be very dissimilar to that. But I always say that a healthy feedback mechanism and scorecard keeping is very essential because it takes you away from having a bias. You might like someone, but they may be giving you the worst advice. How do you get out of that trap? Because you've known them 20 years, 10 years, so they should continue to be your advisor, even though they're not adding value. That's not healthy. Now, how do you get out of that? Only if you keep a scorecard. Only if you don't look at just the portfolio value, spend some time understanding what's happening. Look at the past emails or past things that the person has said and what happened. That will also keep the other person on the hook, right? Because everyone loves to get a feedback. It doesn't mean that you have to change your investment advisor, but you are going to get better advice because your investment advisor will know that you do read, you do follow, you do seek feedback, you look at what has been said in the past. So it works. It works both ways. I'm not advocating anyone to go and change the investment advisor tomorrow because they got the last call wrong. I don't think that is ever going to be healthy. But having a feedback mechanism is really going to make your process better. Just like as an investor, I have my investment process, which keeps evolving. As someone who is allocating money or seeking investment advice, They have to have a process, which should also evolve, and we should take away from biases. I think biases are the biggest thing that everyone has to solve, because we are all human beings. We are susceptible to where we receive the advice, how we receive it, the framing and the environment, and those things have to be worked out.
And one particularly miserable group of market commentators is economists. And I think the economics trade is at a particular low at the moment, especially with like the failures of central banks in recent years. I think Warren Buffett once joked that any company that has an economist has one employee too many, which I quite liked. So what can be done to sort of reinvigorate the economics profession then? Because I think, like personally, I think it's too focused on models, and there's so much kind of disconnect from the reality of what's going on in the world. And even though I loved economics when I was at school, but it seems it's kind of like all theory and no practice. So what can be done to reinvigorate economics? Because this is an important thing for understanding kind of like the framework of how markets work. So what would you say to that?
So I would say that it's the same problem as a problem of religion. So economics, it has become like a religion. So if you look at central banks, so I would suggest that if you go and look at the Fed governors, so if you go on the Federal Reserve Board and look at the 16 or how many Fed governors they have, and look at their experience, they've all worked probably 40 years on average. And I can guess that if you added their work experience and saw what percentage of their life they have spent in private sector, probably it will less than 5%. So this is where the groupthink comes from, because you are in academia, you are in research institutions, you go back and forth from there, you never work in real world. My suggestion is very simple. If you have a monetary policy group, MPC, half the people on that should come from business and half from academia. There should be no reason why you should have 8 economists on MPC or the Federal Reserve Board who's making great decisions. No, you should have CEOs. You should have half and half, half and half straight away. So half people who are really taking the policies, i.e. what the Federal Reserve or any other board decides to do, and half who are academic, because academic have a hugely important role to play, but nothing should be 100% academic, because they are completely immune to the impact of the policies they are making, because they are tenured, they have good pensions, they're not taking risk. If you don't take risk, how are you supposed to really understand what's happening? It's the same problem that kids who inherit a lot of wealth but don't know how to make wealth have the problem, because you've never worked to create wealth. How are you going to? So if a rich person gives a child 100 million and you never train the kid to understand how money is made, that kid is going to just destroy that value. I think I always say to very wealthy people that you spend a lot of time with your kid to really make them understand how money is being made. They should work alongside a portfolio manager rather than just inherit the money. Because no amount of money you're going to earn for your child is ever going to make their life useful if they don't have the value system of how money is being made and what can be done with it, right? But it's the same problem when it comes to academia. If you went from doing a MSc, BSc, MSc, PhD, 10 years in academia, 5 years in government, 5 years think tank, and then you're asked to make monetary policy, you have been tenured all your life, you have massive pensions. How do you feel the problem that, of course, they will always claim to be that, oh, we understand what's happening in real economy. No, you are not even part of the debate group. You are debating with other economists who have same biases that you have. You don't debate with CEOs and business people or a hiring manager or somebody who's trying to pay the salaries and bonuses of people and trying to manage. No, it's not there. So I think that, to me, that is the biggest criticism of policy making globally. That whole profession has been, I'm not saying that economists have done by design. I don't know. Maybe they have done by design, but I don't know. But what I'm saying is that has to be disrupted. And that is the job of a policymaker. Because anybody who is elected has the power really to change these things. If you're an academic and if you are in a group thing, why would you change that? It works really well for everyone. All your friends are academic, or most of them are academic, and you can reward each other and you can make a lot of money out of that legally. Why would you change that gravy train, right? You wouldn't. So it's the elected people that have changed. So I would say that half and half, it should be straight half. Half should be policymakers who have academic background, because you need to understand the data, you need to understand, model the data and the implications and impact, and economists play a very good role in that. And half the people who are from real world, who are being impacted by that. Go and look around in Brussels, ECB, Bank of England, Federal Reserve, anywhere, and show me that there is a balance. There is no balance. You had far more business people in the past than you have today. It has actually gone the other direction. So to me, that has to be a massive, big change if anybody wants to take policymaking seriously and really want to help the people.
I'd love to see that happen, but I don't think I'll be holding my breath. um, so I just want to switch to talking about the current state of the markets. So a lot of investors obviously were kind of like really scarred by what happened with the financial crisis in 2008. And we're kind of constantly on the lookout for the next one, basically. Do you think that's possibly one of the reasons why the current bull market has lasted for so long without having any significant drawdowns? Obviously, give or take COVID, things like that, but that was very quick. And how well do you think the current market is underpinned at these levels?
So I would say that has had an impact, because you look at the data, especially this year, early part of this year, you have seen retail investors have taken more risk and done well than the professional investor. So retail clearly has gone into and made the money and done well. Now, what everyone talks about all the time is the tech stocks, right? So if you look at the concentration of, for lack of a better word, Mag 7, in S&P, and the price to earnings that they have is at a high level, and for good reason, because they are growing their revenue at the rapid pace for 30-40% in many cases. And that is misleading the people. So if you let's look at S&P 500, and historical average of S&P, let's say, is 20 something on PE basis, and now probably it is 23 or 24. And a lot of people are concerned that this is higher than the average, which means the market is overvalued. Now, let's look at two parts. You make S&P 490 and S&P 10, the top 10 stocks, and 490 other stocks. And then if you compare the PE, or let's say make it equal weight, not market cap weight. If you did equal weight, i.e. every stock has 1 by 500, 2% weighting in S&P 500 because there are 500 stocks, then suddenly the PE drops to 16 or some thereabouts, so lower. So if you look at a market as a whole, then we are clearly not overvalued. What is happening is that the big stocks are delivering the earnings, delivering the growth, because the world around is changing. I sometimes think that I don't know why we call tech as a sector. Everyone uses technology. Who doesn't use technology? Tech is just omnipresent everywhere. People have to use technology. So those stocks have become like the railroads of the past. Those are just present everywhere. Everyone has to use it in some form or the other. And this is where the concentration and the valuations are coming from. So either you can look at those stocks and say, well, the whole market is expensive, which is what a lot of people have done who have not been in the market, or try to understand what underpins the valuation and where the earnings are. And on that basis, market is definitely not expensive. And don't be surprised if it continues to rise. Now, of course, you will have the cyclical element, as you saw in April this year, is that if something comes which is not part of this discussion, i.e. tariff, which happened in April, then clearly you're going to have people react to it. But I always say that when you see any news come through, there are two things you should worry, as I definitely think as a portfolio manager. There's one thing that people think about what should happen, and that's where all the biases come in, because you want certain things to be a certain way. Trump should not win election. Trump is bad and all. And so this is what is going to the market. And the second aspect is what is likely going to happen. And this is where, again, understanding of probability and maths always helps me. Is that so when President Trump says something, I start discounting what I think is not going to happen, even though that might be very bearish. So when this year, when the tariff went up, I didn't reduce my risk, because to me, he was never going to win against China. China is on a very strong footing. For that, you need to know the Chinese economy and how they're working and aspects. So having this broad understanding of what the lay of the land is helps you see which policy is going to see through and where US or Trump is going to fold. And he did fold on many things. And he did fold because he couldn't push those things through. But if you took every policy at face value and started reacting to it, then you will be bearish all your life. But the risk just all around you. You get on a bike, you're going to fall. You go on a tube, you're going to fall. You are walking on the street, somebody's going to knock you over. So if you look at, you don't do that in your daily life. Why do you do that in financial market? Oh, Trump said this. Oh, this person said this. Central bank said this. So you start taking impact of each and every announcement and start worrying about. That's not the way to live life. That's not the way to invest or manage portfolio. So my advice always is take all the news, first separate the noise, then look at what are the news coming through, start assigning probability of that happening. If you see probability is low, you ignore it. Probability is high, you take that into account. And then at the same time, always think that the nominal prices are increasing. And nominal price will continue to increase and your cash will be devalued. And when you go and pay at the shop, you pay nominal price. You don't pay real price. You don't go to a sandwich shop and say, I'm going to pay you real price. No, it's the price that includes inflation. So never lose sight of that. You have to have nominal price growth, i.e. your assets should grow nominally. And at the same time, do not jump and react at every negative news and every policy being announced by everyone, because in this day and age of 24/7 news and channels and podcasts and everything, you have so many things being thrown at you. You really need to understand and go back to having the basic framework that allows you to really interpret these news and put 90% of them in a rubbish basket, because it's just not going to happen.
One of the things that you've spoken about in the past is regime shifts in markets. And I just wondered, is there anything in particular what you'd highlight as something that investors still haven't priced in at the moment? And without wanting to go into kind of like the AI stuff too much, because I know that everybody talks about that all the time, is there the potential for kind of like second order effects in AI to sort of spill over to the other non-tech companies when they sort of implement this technology? And is that something that could potentially drive the rest of the market? You talk about the overall market being on something like the P of 16 or whatever. Is there potential there to increase, long-term productivity and earnings potential in the rest of the market?
So I am a big believer that productivity increase is happening and will continue to happen. And I think that AI is helping on that front. So I'm not in the camp that thinks that AI is going to take away jobs. I don't think so. I think that productivity increase will lead to more services. It will lead to people doing their jobs better. I mean, when I look at a newsletter that would take me 2 days to write, I can now write that in 2 hours. That gives me a lot of free time, because I don't have to look at editing and going through paragraphs and all. But that doesn't mean that the time I save, I'm sleeping. I am consuming. I'm using that time in a different way. I'm going maybe with my son to bowling or something. So what I'm saying is that every time that you're saving, and this is where people get it wrong, in my opinion, is that people are going to find other things to do. You just don't know what these other things are going to be. I was walking down the street yesterday and I saw someone like doing, probably he's a YouTuber or whatever. They had a team of 20 people around him. I mean, when you see something on YouTube, you see one person is producing it, but the 10, 15 other people working around it to deliver it. These things you don't know. I mean, we don't know because you don't have to know about every profession. So my simple belief is that the biggest downtrend you can have is when there is a population collapse, which I don't see happening. Humanity collapse. I don't see that happening. Yes, there are trends in demographics that one has to take into account, but I don't think that it is at such a pace, at least for next 10, 20 years, that one has to be alarmed. So in that respect, when I see productivity is increasing, i.e. people are going to have more time and they're producing the same thing in shorter amount of time. Therefore, they can produce more with the free time that they have or consume or any other aspect. To me, that just means that things are going to get I purely talk in terms of economic impact. I'm not saying who is the winner or loser. I'm just saying in terms of economic impact, those things are going to deliver by way of price increases, new companies coming to the market, producing earnings, and doing other things, because that's what we have seen over the last many years. This is already happening pre-COVID. COVID just put a stall on it. Pre-COVID, inflation was not a problem, right? When we talk, people were thinking about you might have disinflation or deflation. I think that this inflation trend is going to continue and reassert itself in a few years because COVID disrupted that supply. Those things have gone away. And in that time, we have developed better and better technology. The supplies have become better. Any bottlenecks or anything has only been removed, not added. So fundamentally, I believe that your supply is getting better, technology has gotten better, productivity is increasing, and that should lead to more GDP. And that should really lead to more economic activity. So I am firmly in the camp that we will be in disinflation. We will have GDP growth. Yes, of course, one can debate about how it is funded, whether it's by debt or deficit, but that is a different discussion. But if we purely talk in terms of nominal GDP, then in my opinion, that keeps on increasing. And that means that you will have asset prices that will keep in line with that. You will have winners and losers in terms of stocks. But at index level, I think you're going to see index keeps on increasing.
That's interesting because obviously with the narrative all being about inflation at the moment, it's nice to get kind of like a different perspective on that. I just want to switch to talking about kind of like the long-term wealth building strategy. Because at Crossbridge, you obviously work with a lot of high net worth clients. What is the biggest misconception that wealthy clients and wealthy families have about investing, do you think?
I would say two aspects. I think that your investment has to be simple, and you have to understand the compounding effect. People are invariably drawn to big returns. People are invariably, so let's say if you see a fund, I will not name anything, but if you look at a private equity fund that tells you they do 15% IRR or 20% IRR, you would just get super excited. You lock your money for 7 years, 10 years, and you think that you're going to get those IRRs. You're not getting those IRRs. IRRs are not real. They are fictional numbers. They're not real numbers. So I always say investors should look in terms of cash on cash return. Look at what money is going in and what you're getting paid. And I can tell you that if you're able to do 10 to 12% per annum, and which is not very easy to do on a consistent basis, then you'll be far wealthier than anybody who's chasing any exciting product or return. Because the human mind is very, very strange. People always forget their losses. They just remember their winnings, which is why there are so many FX brokerage houses in this world, because they play on that. Because you keep doing FX trade, you keep losing money, but once you will win. And that win is exactly the only thing you will remember, because that's what you want to remember. And that's what you want to tell your friends about. So I always say that if you're doing a low double return without taking a huge amount of risk and leverage, you're doing extremely well, because what you should really compare to is over 3 to 5 year long term. Don't compare yourself over a monthly, quarterly, because that's where people get it completely wrong. They certainly have a win over 3 or 6 months and they get super excited and super bull on, I understand this as a class, understand this, and they go all in, then they lose their money. So I think that's not the way to do it. Way is that you really have to understand portfolio has to be built up. It takes time. Anything, if it is too good and too high return, it's not going to last. Either it'll get arbitraged away or it is too good to be true, so it never was. So I think that those are very simple things, which doesn't change from whether you're investing 100 years ago or what will be 100 years from now. So if you can do that and have a strategy where you're making your returns in a predictable manner. I mean, what we do with our clients, we always say that our goal is to make between 10, 11% per annum over a 3 to 5 year cycle. We never say it's going to be per annum. You're not going to get 10% per annum, because when you put investment strategy like we do on single stock and stock basket, you cannot be just clipping coupon on a monthly, quarterly basis. It's not a bond investment. There's a component of capital increase plus the income element. But if you do that over 3 to 5 years, then you will be outperforming most of the professional managers, let alone the retail investors. And also your investment philosophy or the way you invest comes with the size of portfolio you have. Depends on the size of portfolio. So if you have really large portfolio, then you have to have an element of like, I need to keep these capital as well. When you have smaller portfolio, then understand your focus is more on building and having high returns, but never lose sight that in building those high returns, you may actually lose that small money you have. So there is no really excuse to not having a disciplined way of growing your money, which will really compound over time and make you that return. And to me, that is the key thing that every investor has to understand, whether you're a big or a small investor. The big or small investor, what happens is that they can put a bigger capital on the winning trades, so they make more money out of it. But all your trades are never going to be winning trades. So sizing your trades is very, very important. And the reason big investors make a lot of money because they're able to put big capital on a relatively less risky trade, and the dollar value of that increases and makes them a lot of money. But to get to that stage, when you start from a small or medium investor, you have to grow that capital. And that growing capital at 10, 12% is highly attractive, in my opinion, than shooting for 20, 30% illiquid assets and all the funky thing that gets thrown around to investors everywhere. And you got to see through it, and you got to have the discipline.
Just picking up on that element then about sizing your trades, how do you balance how do you balance diversification versus concentration? Because obviously we talk to diversify, don't put all your eggs in one basket. But then on the other hand, we know that the managers that do tend to really outperform are the ones that are more highly concentrated. So what's your perspective on that?
Sure. I mean, I would say that depends on what you're doing with that basket. So as the saying goes, you can keep all your things in the same basket and watch it carefully. So I think that strategy may work for you. So I would say that academically, a lot of report has been written how many stocks you should have in your portfolio. I mean, we don't have a lot of stocks in our portfolio. We do mostly structured equity trade where we create trades on basket of stocks or indices. But if we look at any of our portfolio, we will not have more than 25 names. So, or maybe 30 in some cases, or 20, 25 mostly. So I'm not saying that you have to have every stocks or diversify so much that, you basically end up giving away your returns. So running a concentrated portfolio is a good thing, not a bad thing in my opinion. I think you need to take a concentrated bets on things you understand, and you don't have to have all 10 sectors in your portfolio. I mean, a lot of structured note that we create, I think stocks are mostly around consumer, tech, industrial, financials, I would say, most of them, because these are by consumer, I mean both discretionary and staples. So if you can get a decent basket of stocks to work with, which is delivering you returns, then you should stick to it. There's no reason to be doing anything else. And as to what percentage of your basket you should be in fixed income or equity will be driven by what stage of the life you are in, and what do you want that portfolio to do for you. I mean, I can create structured notes where there will be income element, which can be a bond proxy for the portfolio. And then I can have other stocks or ETFs, which are going to be the equity allocation for the portfolio. So we could do that as well. So that is, I mean, one can discuss with the investment advisors and create that. But having more concentration is a good thing, not a bad thing, in my opinion.
What would you say to younger investors who are kind of just entering that phase of their life where they're starting to build wealth? What should they do differently to previous generations? Because previously we've had, everybody's been obsessed with the 60-40 model of portfolios, but that's now considered to be broken. So what would you say there?
Yeah, I will come back to the same thing that, you have to have participation in the economy. And to me, that comes from equity. So bond serves a purpose because that gives you the income. But if you're really starting to be a new investor, you're a young investor, and you have to build capital and build asset base, bond is never going to build you that asset base. Let's be honest about it. So you should really be having more equity investment. And that's up to In equity also you can range of risk, right? You can have high dividend yield stocks, which are in a way bond proxy. But of course, it is going to move down if S&P 500 was to correct. But if you have a high dividend paying stock and you can take the drawdown, are you concerned about it? It depends on when you need that capital. So if you are building a portfolio, your goals have to be established. When do you need this money? How long can you hold it? And can you take the drawdown? And I think the answers to that, if you can take the drawdown, then you got to have the medium-term mentality to do that. The reason I do structured notes, because it can handle drawdown much better. I always say that I bring the private equity mindset, i.e. long-term thinking, to the liquid way of investing using stocks. That's what I do. So when I create note structures, which are 3 to 5 year structures, which can give me a coupon element of 12 to 14% per annum, or slightly more in some cases, I can choose my protection, choose my different layers of thing to create a note or structure that meets my requirement of how much income I can generate from this investment strategy. So similarly, if you're just running only a stock-only portfolio, you can choose your stocks as a combination from defensive stocks to growth stocks, and that gives you the level of growth you're looking at. Or in cases of you want to be very defensive and go only for high dividend yield stocks, you can have that. So what I'm saying is that somebody else's risk profile should not be a risk profile. People always look at others, start copying them. That's just the wrong way. I think you have to sit down and look at yourself, look at your asset base, look at your sources of income, what your future earnings are going to be, and decide whether you should be I would say, 100% equity or less than that. I mean, I still own in most of my own personal investment, it's mostly equity, even in my pension, because I don't think I need any bond investments to help me. So don't be driven by what everyone tells you. You will have market corrections. You will have drawdowns. If you go to your computer now or later and plot what the interest rate has done over the last 25 years and what S&P has done, it gives you the answer. Interest rate has gone all the way to 7, 8, to 0, back to 6, and S&P has been just going up in one direction. Why? Because those stocks are participation in the economy, participation in how the world is being built, how the earnings are developing. But then you had a drawdown. Oftentimes you see on LinkedIn, people say, if you had bought $1 of Amazon in 1999, then you would be $1 million. But that's wrong, because if you bought that, you had to sit through minus 75% 4 times before you got to $1. You would never get to $1. That's the short answer. It's very easy to write that. But if you go through that process, but if you knew, or if you understood at that time that this is the company of the future, I don't care about drawdown, I'm looking at how things are being built up, they're going to solve things, then you made that money. The same thing happens now when you're creating your portfolios.
I think the other thing people miss out on is the fact that that Amazon would be such a huge component of your portfolio. I mean, surely any sort of rational person would have sold down that position as they went as well,
Yeah.
to rebalance. But so to cap off then, Manish, I just want to get a bit philosophical. I'm aware that you're a student of philosophy. Is there anything in particular, do you think, that investment has taught you about life in general? For instance, has it made you a more patient man? Because we know, obviously, patience is a great virtue when it comes to investing. And also, what does financial freedom mean to you, and what does it look like?
Yeah. So I'll take the second one first. I think, to me, financial freedom really means having control of your time. To me, that is wealth. The real wealth is that you have control on your time, and you have choosing of your time to do the things you want to do. You can be a multi-billionaire and working 20 hours a day, and that to me is not freedom, because you do not have time to what you're doing. So I think that, to me, financial freedom is that, to have the time to play with my son football and go where I have to go, and the living expenses are taken care of. To me, that's freedom. To me, that defines wealth. The first part of your question, I always say this to everyone and to myself, that I always say, enjoy the process, fall in love with the process, not the outcome. Because if you're outcome driven, you will always be unhappy, always have anxiety, because you're living in the future of what will happen in 2 years' time. I need this, I need that. I'm not saying that you should not have goals. You should have goals. You should have goals, which are medium term, 3 to 5 year. What I am today is based on the goals I set 5 years ago, not what I'm setting today. So you should have goals. But when you fall in love with the process, not outcome, that gets you a better outcome. Because ultimately, the outcome is based on what you're doing every day. And that's the process. So when I wake up, I'm always excited about what's happening because in our world, it's full of data and things happening. Stocks are going up, earnings are increasing. You're learning about new things, new companies, and you really get excited about what is happening. And that is the process. In that process, you discover good stocks, good businesses, good partnerships, good business building. And that's what really we should care about. Because if you have your process correct, you will have a good outcome. And if you're sitting over there looking at your portfolio, what's happening? Oh, this stock is down 10%. And people should really do this exercise that once they have selected a portfolio, maybe, which is why I said first about scorecard and feedback. So many times clients have the right portfolio and they keep changing it and destroy it. If you were to go back and look at the first portfolio you had when you sat down and chose something and be very honest to yourself, is it how that would have performed if you had not made these changes based on news flow? You will be shocked and surprised that you would have done better. I've seen many cases where they have done better. And that's what I always say, that don't worry about the noise. The noise is never going to go away. You can't shut yourself out from that. You just have to know that you have a process that you're working on, and that should give you the strength to see through it. And so I always say, fall in love with the process, not the outcome.
Sage words. Thanks for your time today, Manish. I really enjoyed the conversation, and I hope we can get you back on the show at some point as well. And
Thank
all
you.
the best at Crossbridge.
Thank you very much, James. Thanks for having me.
Thanks again to Manish for his time today. You can hear more from Manish at crossbridgecapital.com and via his LinkedIn feed. Thanks for listening, everyone, and if you enjoyed the show, don't forget to follow and give us a like so we can continue growing the community.